The US-China trade war has entered a dangerous new phase. Tensions, simmering for years, have boiled over once again. President Trump, on April 1, 2025, announced a significant escalation of tariffs on Chinese goods. This move, defying the advice of many economists and businesses, has sent shockwaves through the global economy. The world watches with bated breath, uncertain of what the ultimate consequences of this gamble will be. The tariffs, the highest in over a century, represent a substantial increase from previous levels. They target a wide range of Chinese products. These products are essential to American consumers and businesses. The stated goal is to protect American jobs and intellectual property. However, many experts believe they will have the opposite effect. This escalation comes after a period of relative calm in the trade war. The two countries had reached a tentative truce in 2023. This truce, known as the Phase 1 agreement, had eased some tensions. However, it failed to address many of the underlying issues driving the conflict. The new tariffs effectively tear up this agreement. They mark a return to a more confrontational approach. This decision reflects the Trump administration's belief that China has not lived up to its commitments. The administration argues that China continues to engage in unfair trade practices. They cite issues like forced technology transfer and intellectual property theft. They believe that these tariffs are necessary to force China to the negotiating table. The goal is a fairer trade relationship for American businesses and workers. The global financial markets have reacted to the escalating trade war with predictable alarm. Stock markets worldwide plunged following the announcement of the new tariffs. The Dow Jones Industrial Average, a key indicator of American economic health, experienced its worst week since the 2008 financial crisis. The tech-heavy Nasdaq, already reeling from recent volatility, entered bear market territory. The sell-off was not limited to the United States. European and Asian markets mirrored these declines. Japan's Nikkei index and the German DAX both experienced significant drops. Investors, fearing a full-blown trade war and its potential impact on global growth, fled to the relative safety of bonds and precious metals. This market turmoil underscores the interconnectedness of the global economy. Even countries not directly involved in the trade dispute are feeling the effects. The tariffs, by increasing the cost of goods, threaten to disrupt global supply chains. This disruption could lead to higher prices for consumers and businesses worldwide. The uncertainty surrounding the trade war is also taking a toll. Businesses facing unpredictable costs and demand are hesitant to invest and hire. This hesitancy could further dampen economic growth. The International Monetary Fund, IMF, has already downgraded its global growth forecast for 2025, citing the trade war as a significant risk factor. Despite the market turmoil and growing concerns from the international community, President Trump remains defiant. He has defended his decision to escalate the trade war, arguing that it is necessary to protect American interests. He has dismissed the market reaction as overblown and temporary. In a series of tweets, Trump reiterated his belief that China has been ripping off the United States for decades. He accused previous administrations of being weak on trade. He vowed to continue his tough stance until China agrees to a trade deal that is fair and reciprocal. Trump has also lashed out at the Federal Reserve, accusing it of undermining his economic agenda by keeping interest rates too high. He has repeatedly called on the Fed to cut rates, arguing that this would boost the economy and offset any negative effects from the trade war. This pressure on the Fed has raised concerns about the politicization of monetary policy. Critics argue that Trump is attempting to bully the Fed into acting in his political interests, rather than in the best interests of the economy as a whole. China, for its part, has responded to the US tariff escalation with a mixture of retaliation and restraint. Beijing immediately announced retaliatory tariffs of its own on a range of American goods. These tariffs, carefully calibrated to inflict maximum political pain, target key American exports like agricultural products and automobiles. However, China has also signaled a willingness to negotiate. Chinese officials have emphasized the importance of dialogue and compromise in resolving the trade dispute. They have reiterated their commitment to opening up their economy and addressing some of the US concerns. Beyond tariffs, China has other tools at its disposal. It could devalue its currency, making Chinese exports cheaper and American imports more expensive. It could also restrict access to its vast market, which is a major source of revenue for many American companies. However, China is also wary of escalating the trade war too far. It recognizes that a prolonged conflict would harm its own economy. It also wants to avoid being seen as the aggressor in the dispute. This delicate balancing act suggests that China is pursuing a strategy of calibrated retaliation, aiming to inflict economic pain on the US while keeping the door open to negotiation. The escalating trade war has put the Federal Reserve in a difficult position. The central bank, tasked with maintaining price stability and full employment, is now facing a complex economic landscape. The tariffs, by increasing the costs of imports, threaten to fuel inflation. However, the trade war is also creating uncertainty and slowing global growth, which could argue for lower interest rates. The Fed, after its latest meeting, decided to hold interest rates steady. However, it acknowledged the growing risks to the economic outlook. Fed Chair Jerome Powell, in a press conference, stated that the central bank is closely monitoring the trade situation and is prepared to act as appropriate to support the economy. This cautious approach reflects the Fed's dilemma. Cutting rates too soon could fuel inflation, which is already showing signs of picking up. However, waiting too long could risk a sharp economic slowdown. The Fed is walking a tightrope, trying to balance these competing risks. The Fed's decision to hold rates steady for now suggests that it believes the economy is strong enough to weather the initial impact of the tariffs. However, it also indicates that the central bank is prepared to reverse course if the economic outlook deteriorates. The trade war between the United States and China is not a bilateral affair. Its shockwaves are rippling across the global economy, impacting countries far beyond the two protagonists. Major economies like Canada, Japan, and the European Union are all feeling the effects, as the trade dispute threatens to disrupt global supply chains and dampen growth. Canada, heavily reliant on trade with both the United States and China, is particularly vulnerable. The Canadian dollar has weakened against the US dollar, making imports more expensive. Canadian businesses, facing uncertainty about future demand, are holding back on investment. The Canadian economy, once robust, is now showing signs of slowing down. Japan, a major exporter of automobiles and electronics, is also feeling the pain. The escalating trade war threatens to disrupt Japanese supply chains and reduce demand for Japanese products. The Japanese government has expressed deep concern about the trade dispute and has called for a swift resolution. The European Union, already grappling with its own internal challenges, is now facing the prospect of a trade war on two fronts. The EU is caught in the crossfire between the United States and China as both sides threaten to impose tariffs on European goods. The EU, while urging dialogue and restraint, is also preparing to retaliate if necessary. The escalating trade war has exposed divisions within the European Union on how best to respond to the United States' aggressive trade policies. Some member states, particularly those with strong economic ties to the US, favor a more conciliatory approach. They argue that the EU should try to negotiate a solution with the United States, even if it means making some concessions. Others, however, believe that the EU should take a tougher stance. They argue that the United States is acting unilaterally and in violation of international trade rules. They favor imposing retaliatory tariffs on US goods and challenging the United States' actions at the World Trade Organization. This division within the EU reflects the complex challenges posed by the trade war. The EU is caught between its desire to maintain good relations with the United States, its largest trading partner, and its need to defend its own economic interests. The EU's response to the trade war is further complicated by its own internal divisions. The bloc is struggling to maintain unity in the face of rising populism and nationalism. The trade war, by exacerbating economic anxieties, threatens to further strain relations between member states. The escalating trade war has raised fears of a global recession. Economists warn that the tariffs, by disrupting global supply chains and reducing demand, could trigger a worldwide economic downturn. The International Monetary Fund, in its latest World Economic Outlook, warned that the trade war is a serious threat to global growth. The risk of a recession is particularly high if the trade war continues to escalate. A full-blown trade war, with tariffs imposed on a wide range of goods, could shave percentage points off global GDP growth. This slowdown would have significant consequences for businesses and workers worldwide. The trade war is also fueling uncertainty, which is weighing on business investment and consumer spending. Businesses facing unpredictable costs and demand are hesitant to invest and hire. Consumers, worried about the economic outlook, are cutting back on spending. This decline in business and consumer confidence could create a vicious cycle, leading to further economic contraction. The longer the trade war continues, the greater the risk of a recession becomes. The escalating trade war between the United States and China has cast a pall over the global economy. The tariffs, the market turmoil, and the growing uncertainty have created a climate of anxiety and fear. The world is watching nervously as the two economic superpowers engage in a high-stakes game of chicken, unsure of who will blink first or what the ultimate consequences will be. The trade war is not just about economics. It is a symptom of a deeper geopolitical rivalry between the United States and China. This rivalry, fueled by ideological differences and competition for global influence, is likely to continue regardless of the outcome of the trade dispute. The world is at a crossroads. The path chosen by the United States and China in the coming months will have profound consequences for the global economy and for the future of the international order. The stakes are high and the outcome is far from certain.